Before 2024, investing in Bitcoin was daunting for most people. The process was filled with technical hurdles and uncertainty, making it feel inaccessible to the average investor. Many were intrigued by the potential of cryptocurrency, but the risks and complexity kept them on the sidelines, watching from afar as prices soared and crashed. Crypto exchanges, digital wallets, and private keys kept mainstream investors at bay. The fear of losing access to funds or falling victim to hacks made even the most enthusiastic newcomers hesitate. For years, only the tech-savvy or the truly adventurous dared to navigate the world of digital assets. The approval of spot Bitcoin ETFs on January 10, 2024, changed everything. It was a watershed moment, making headlines around the world and sparking conversations in boardrooms and living rooms alike. Suddenly, Bitcoin was no longer just a fringe experiment. It was entering the mainstream financial system. Now, anyone with a brokerage account could buy a product tracking Bitcoin's price. No technical know-how required. Investors could simply log in, search for a ticker, and add Bitcoin exposure to their portfolios as easily as buying a stock or bond. This seamless experience removed the biggest barriers to entry. This move by the SEC signaled regulatory acceptance and legitimized Bitcoin for institutions and everyday savers. It reassured skeptics that the market was being watched and protected, and gave large financial firms the green light to participate openly. The ETFs provided a secure, regulated on-ramp for capital to flow into crypto. Billions of dollars poured in as investors sought exposure without the headaches of self-custody or the risks of unregulated exchanges. The market responded with enthusiasm, and trading volumes surged. Investors no longer worried about custody. Trusted ETF issuers handled it all. These institutions brought decades of experience in safeguarding assets, giving peace of mind to both individuals and large organizations. The fear of losing Bitcoin to a forgotten password or a cyber attack faded into the background. This accessibility unleashed pent-up demand and marked a psychological shift. Bitcoin was now a serious asset class. Investors who once dismissed crypto as too risky or speculative began to reconsider, and financial advisors started recommending Bitcoin ETFs as part of diversified portfolios. By late 2025, the market had matured rapidly, with dozens of new crypto ETFs launched. Competition among issuers drove innovation, leading to lower fees, new features, and even more ways for investors to gain exposure to digital assets. The ETF landscape became a vibrant ecosystem. The simple act of making Bitcoin accessible through familiar channels fundamentally altered the investment landscape. It bridged the gap between traditional finance and the digital frontier, making it possible for anyone to participate in the future of money. It paved the way for deeper integration between traditional finance and the digital asset world. As more investors embraced this new reality, the lines between old and new finance began to blur, setting the stage for the next era of global investing. When the race to launch a Bitcoin ETF began, two financial titans, BlackRock and Fidelity, immediately surged ahead of the competition. Their reputations for innovation and trustworthiness set the stage for a new era in digital asset investing, capturing the attention of both Wall Street and Main Street investors. BlackRock's iShares Bitcoin Trust, known as IBIT, made headlines by attracting an astonishing $37 billion in assets within its first year. This wasn't just a strong debut, it was one of the most successful ETF launches in financial history, signaling a seismic shift in how investors viewed Bitcoin as a mainstream asset. By October 2025, IBIT's assets had soared past $56 billion, even overtaking the long-established iShares Gold Trust. This remarkable growth highlighted the increasing appetite for digital assets and demonstrated that Bitcoin was now competing with traditional safe havens like gold. Fidelity's Wise Origin Bitcoin Fund, or FBTC, was not far behind. It quickly became Fidelity's largest ETF, amassing $21 billion in assets. This rapid ascent underscored the growing confidence among both retail and institutional investors in regulated Bitcoin products. For millions of clients, these ETFs offered a straightforward, secure way to add Bitcoin exposure to their portfolios, without the technical hurdles or security concerns of direct crypto ownership. The overwhelming success of BlackRock and Fidelity's offerings proved that demand for regulated, accessible Bitcoin investment vehicles was far greater than many had anticipated. Investors of all backgrounds flocked to these products, eager to participate in the digital asset revolution. With their deep expertise and established reputations, BlackRock and Fidelity brought a new level of professionalism and trust to the crypto space. Their involvement helped legitimize Bitcoin for a broader audience, attracting a new class of investors who had previously been hesitant. This powerful convergence of Wall Street's financial might and crypto's innovative spirit is now fueling the next wave of growth, setting the stage for even greater adoption and transformation in the world of finance. Amid the ETF boom, Grayscale Bitcoin Trust, or GBTC, staged a remarkable comeback. Once the only way to get Bitcoin exposure in a brokerage account, GBTC faced outflows after converting to an ETF. Many predicted its decline, but as Bitcoin rallied, GBTC became the best-performing non-leveraged ETF of 2024, returning 145%. Its long history and established presence helped it retain a substantial asset base. GBTC's journey from a niche product to a leading ETF highlights the market's maturation. It's a story of resilience, regulatory battles, and the powerful demand for accessible crypto investments. Grayscale's transformation is a key chapter in crypto's integration with mainstream finance. As Bitcoin ETFs soared, the SEC approved spot Ether ETFs in 2025, igniting a new wave of excitement. Ethereum's unique value as a decentralized computing platform attracted fresh institutional interest. In August 2025, Ether ETFs saw $387 billion in inflows, while Bitcoin ETFs had outflows. Ether's price hit new highs fueled by intense demand for regulated exposure. In just months, Ether ETFs amassed nearly $29 billion, over 5% of ETH's market cap. While Bitcoin ETFs still dominate in size, Ether's rapid rise signals a maturing, more sophisticated market. Investors now recognize the distinct value of different blockchains. The rise of Ether ETFs marks a new chapter in digital asset investing. Spot crypto ETFs have transformed digital assets from a niche investment into a core part of institutional portfolios. What was once considered a risky frontier is now being integrated into the mainstream financial system, thanks to these new investment vehicles. Accessibility is the key. Institutions can now invest in Bitcoin and Ether through familiar, regulated channels, removing many of the barriers that previously kept them on the sidelines. This shift has opened the door for pension funds, endowments, and asset managers to participate in the crypto market with confidence. With regulated ETFs, compliance and transparency are prioritized, making it easier for large organizations to meet their fiduciary responsibilities while exploring new opportunities for growth. Trusted names like BlackRock and Fidelity gave the green light for mainstream adoption, signaling to the market that crypto is here to stay. Their involvement has brought a new level of credibility and trust to the space. Even Vanguard, long known for its cautious approach and anti-crypto stance, is reportedly reconsidering its position, a potential game-changer that could accelerate adoption even further if they decide to enter the market. Corporations are now adding Ether to their balance sheets, viewing it not just as an investment, but also as a foundational piece of future financial infrastructure. This move reflects growing confidence in the long-term utility of digital assets. As more companies and funds allocate resources to crypto, the industry gains momentum, attracting further interest from both traditional finance and innovative startups. This institutional embrace creates a powerful feedback loop. More adoption leads to greater legitimacy, which in turn brings more stability and encourages even broader participation. The question is no longer if institutions will adopt crypto, but how quickly and to what extent they will integrate it into their strategies. Regulated ETFs have made Wall Street see crypto as a compelling opportunity for both growth and innovation, setting the stage for a new era in global finance. With Bitcoin and Ether ETFs thriving, attention is shifting to the next wave altcoin ETFs. Solana and XRP are leading contenders, with multiple ETF filings already submitted. Solana's speed and ecosystem make it a prime candidate. XRP's legal clarity adds to its appeal. Other coins like Litecoin and HBAR are also in the running. A more favorable regulatory environment in 2025 could accelerate approvals. The success of Bitcoin and Ether ETFs set a clear precedent and market demand. The question isn't if, but when we'll see Solana or XRP ETFs. This next wave will offer investors more choices and diversification in the crypto market. Beyond single-asset ETFs, multi-token and thematic crypto funds are emerging. Crypto index ETFs will let investors own a basket of top digital assets, reducing single-asset risk. Grayscale and Bitwise are leading efforts to launch these diversified products. Thematic ETFs, like those blending Bitcoin with carbon credits or offering downside protection, are also on the horizon. These innovations make crypto investing more accessible and tailored to different risk appetites. The market is maturing, offering tools for both broad exposure and specialized strategies. Crypto ETFs are evolving from simple access to sophisticated investment solutions. Despite the success of crypto ETFs, significant risks remain. Volatility is ever present. Prices can swing sharply, even on positive news. Crypto markets are sensitive to macroeconomic factors like inflation and interest rates. Regulatory uncertainty is another major risk. Policies can shift quickly with political changes. Features like staking rewards and Ether ETFs depend on regulatory approval and could be delayed. Investors must remember, this is a nascent, rapidly evolving asset class. ETFs make access easier, but don't eliminate underlying price risk. Convenience shouldn't create a false sense of security. A disciplined, long-term approach is essential. Understand the risks before investing. Crypto's potential is huge, but so are its challenges. As crypto ETFs multiply, investors need to navigate wisely. First, educate yourself. Know the difference between Bitcoin, Ether, and index funds. Understand how each fits your goals and risk tolerance. Watch fees closely. Low costs matter, especially as new products emerge. Innovation is exciting, but complexity brings new risks. Read the prospectus before investing. Don't chase hype. Stick to strategies you understand. Simpler products often work best for long-term success. Only invest what you can afford to lose. Crypto remains speculative. Avoid FOMO and keep allocations small within a diversified portfolio. Stay informed, manage costs, and maintain discipline. That's how you can participate in this transformative asset class without taking on undue risk.